Yo, how's it going? It's your boy Looney back at it again with another video, and today we're going to go over a great topic, and that is why expiration date is important when selling options, because that's what I like to do. I like to sell options. And today it is September 10th. My account is currently sitting at 22K. So when you sell options, you are not just speculating that the stock is going to move in sudden direction. It's more of a neutral strategy. It's either neutral, well, all the selling strategies are neutral to bullish. And you're taking on the obligation to either buy or sell the stock if the buyer exercises the option. And we're just looking at puts just for easy to follow sake. And that would just mean buying. You're putting on the risk of buying the stock at the strike price. And this obligation only happens until the expiration date, which is your key to managing risk. And once it hits this date of expiration, one of the two things can happen. I'm going to show you right here on September 20th. So either your option expires worthless and you get to keep the premium, or you have to fulfill your obligation of buying the shares at the strike price, $7. This is really important. So let me just quickly stop. So if you stay above the $7, you collect the premium of $27. If it goes below, you're required to buy the shares at $7, which isn't necessarily a bad thing, but you're not getting your full profit. As the seller, time decay is your best friend. Every day that passes, the option loses value. And this is very apparent as the expiration gets close to the end date. And this is actually good news because it increases the chances that the expiration of the option expires worthless. And this lets you keep the premium without having to take any further action. So what do I mean by this? So as you get closer to expiration, it's pretty certain of where the stock is heading or going, unless a big news update or something shifts the stock to make sudden moves. So as you get closer to expiration date, it's more certain of where this stock is going. Okay, so we're going to look at selling options on a shorter expiration date and a longer expiration date. So when you sell options with a shorter expiration date, this typically means a higher rate of time decay, which can be an effective way to maximize profit in a shorter period. So let me just stop here, because if you go to September 20th, the $7 put is $27. But if you go 2 weeks out from this, it should be around 54 because it's just two more. It's times 2. And we go there and it's 49. So it's a little bit less. Your ratio is a lot less. But it's a lot more risky because there's less cushion. You're only getting $27 premium. And if the stock makes a sudden movement, you're required to make this purchase and also your higher chances of not gaining a profit. So although you can get maximize profits in the short-term period, it also carries risk because the buyer has less time for their option to lose the value, which is what I just explained. So on the flip side, if we go to an option with a longer expiration date, it gives you more premium, as you guys can see, but also more time for the stock to move against you, increasing the chance for the option to get exercised or signed. So what do I mean by that? So it's less likely for in the news that a stock is affected in like a 3-day period. But over months, you don't know if like a lawsuit is happening or something that occurs the stock to move in sudden ways. So that's why you get more premium. And although uncertainty is more, on a long-term basis, stocks tend to move upwards. So the rate of the premium you're getting is a lot less. So expiration dates give you more premium, but more time the stock to move against you. So it can continue going down and down, and you might be obligated to buy and miss out on doing these shorter term trades where you could do $7 put and then a $6 put and then a $5 put and just continue doing that. Where this, you're locked in at $7. So whether the stock goes down a lot or up a lot, you're locked in over this long period. So that's why choosing expiration dates is crucial. Short-term options may give you more quicker profits, but with higher risk, while longer terms give you more premium, but give you more exposure risks, allowing for big things to happen. And another way of explaining this is that the stock, when it moves on a short-term basis, it affects you more because you have less premium or a less cushion to work with. And your goal as a seller for the option to expire worthless. You want this to expire worthless. So time is actually on your side. So as you get closer to the expiration date, you are more certain of where it's going. But always remember that as expiration approaches, market volatility can spike and sudden movements can force you to fulfill your contract, what I explained before for shorter term contracts. And as you guys can see, I have a bunch of contracts with different expiration dates. 1 to 6 weeks is what I do. And that's what the consensus tells you to do. 1 to 6 weeks is a good middle ground of managing risk and exposure risk. And as you guys can see, I have some that are short term, 1 week, and then a few that are longer term, a few months or a month. So in conclusion, mastering expiration dates when selling options can be the difference between steady profits and expected risks. I hope you guys enjoyed this video. Don't forget to like, subscribe, join my Discord, follow me on Twitter, and have a good one. Peace.